All right, good morning and welcome to GLI's COVID-19 Help Resource. I'm Sarah DeVasher Wisdom, President and CEO of Greater Louisville, Inc., the Metro Chamber of Commerce. We're so glad that each of you were able to join us today. It's hard to believe that 8 weeks ago we were shaking hands and congregating and watching in disbelief what was happening in China, then Italy, and then here it was on U.S. soil. I know that we're all ready for more certainty. Before I turn it over to our investment industry experts today, I want to talk a little bit about the renewal task force that GLI has formed to help consider reopening our regional economy. It looks like we have our chair of the task force here on the call, Carrie Stimler. So we're grateful to Carrie for his leadership on the task force. We had so many people reaching out to say that they wanted to be part of this effort. We called it the Renewal Task Force because the term renewal means to restore, revive, to make new. And that's exactly how we want to come out of this crisis. We have divided the groups into two groups. We have divided the task force into two groups. One of them is focused on advocacy and education. We know that is a big part of our way forward to be strong through advocacy, federal relief, and helping businesses know what relief is out there. And then the second group is on restarting the economy. We're actually in the process just this week of developing a very comprehensive proposal for Governors Beshear and Holcomb to consider reopening the economy. We had a number of industry experts join us for webinars yesterday to talk about this very thing, what protocols they've put into place so that we can reopen in a safe and healthy way. We also know that the stock market is a big indicator of our economy's health, and that is why we have brought to you today a couple of industry experts to talk about that. We have Jim Allen and Bruce Bittles from Baird, GLI Top Investor. We will be using the chat feature for any questions today. After we hear from Jim and Bruce, we will be taking questions from you. So please utilize that feature and we will get to as many questions as we can. Our team will be compiling them throughout the presentation. Also want to mention that Baird has provided us with a copy of their disclosure statement. Please let us know if you need a copy of that. It is here on your screen now. So with that, I'd like to welcome GLI past board chair, Jim Allen. Jim is also the vice president of Baird, and he will introduce our guest today. Jim?
Great, thank you, Sarah, and good morning, everybody. Thank you for joining us. Sarah, we appreciate your leadership. Carrie Stemler, thank you for stepping up. As we look to sort of re-engage in terms of getting back to business. I'm not sure it'll ever be back to business as normal, but as we make our way back to a more normal set of conditions. Obviously, the market conditions and the economic circumstances are truly unprecedented, and that's why I think today's conversation and presentation by Bruce Bittles will be especially timely. Bruce is the Chief Investment Strategist at Baird. He joined Baird in 2002 and is responsible for market analysis that's delivered to individual clients, institutions, and their corporate clients as well. He has a long history in the industry, a head trader at an options trading firm in New York before joining J.C. Bradford to start the options department at J.C. Bradford, and then moved on into the research department at J.C. Bradford as the partner in charge of market strategy. Of course, J.C. Bradford was acquired by Payne Weber in 2000, and it was ultimately acquired by UBS. As I said, he joined Baird in 2002, is a frequent guest on CNBC, and I've heard Bruce speak on a number of occasions, and he delivers his message in a very common sense way. So I think you're going to enjoy hearing from him as he provides his insights regarding this unprecedented economic set of conditions that we have, and obviously market volatility that has followed that. So with that as a little bit of background, Bruce, we are so pleased to have you here today. Thank you so much for your time, and we look forward to hearing your thoughts and insight. Bruce Bittles.
Yeah, well, good morning, everybody, and thank you, Jim, for that introduction. Normally, I would follow it up by saying that I'm happy to be here, but I'm not so sure how accurate that would be now that we're doing this with the webcams and Zooms. But in any event, we've been on a wild roller coaster ride in the stock market for sure. And what our attempt what we're going to attempt today is to bring some clarity to that, where we stand at the moment and what the future might look down the road and going into 2021. We've never seen a stock market performance change so rapidly than we saw in the first quarter of 2020. It was just the start of the year back in January. Things were looking very, very upbeat. I mean, by the time we got to the middle of February, the S&P was up 5% for the year, and that was on top of a big 30% gain for 2019. So everything looked pretty rosy. The one caveat I would offer with that, though, and we'll go into this a little deeper later on, those big runs in 2019 and earlier in the year left the stock market in an area where valuations were pretty stretched. But nevertheless, the first part of the year started off with a lot of promise. Then, in 23 days, the market dropped 34% from its all-time high in February. That was the fastest drop ever. I mean, I've been associated with a lot of moves in the market going back to 1974, 87, 2000, 2007 and 8. But this beat all of those in terms of speed, velocity, and then again, we never did have in those periods a complete economic shutdown. That just never happened until here. So we went from a new all-time high in the S&P in mid-February, and then 3 weeks later we were in a bear market. So it was unprecedented. The bear market's defined as a drop of 20% from the stock market from a recent high, and that puts you in the bear market category. So we moved into there very, very quickly. The immediate cause for the decline, of course, was the global pandemic, and we're continuing to suffer from the effects of that. Additionally, we became victims of a price war in the oil market between Saudi Arabia and Russia, and that sent oil prices plummeting. Now, just 10 years ago, that wouldn't have made a big difference. As a matter of fact, it would probably be considered a big positive because gasoline prices would drop, home heating oil prices would drop, and the consumer would have basically what you would call a tax cut. But that all changed in recent years as the U.S. became the #1 producer of energy in the world. And so it became 5% of our economy, and it represented a lot of high-paying jobs. So that break in oil was significant, and it continues to be a problem going forward. The stock market now has risen spectacularly. It's up about 28-29% from the March 23 low, and that's the fastest, strongest rally in a bear market in 90 years. So it's almost unprecedented. But this is the reason why we ask our clients to stay calm in periods of high volatility and not try to make investment decisions when the market is in this roller coaster mode. The question, of course, I'm getting from all areas is, why is the stock market rallying in the middle of a global pandemic while most of the country is in a lockdown and not spending, with dire economic forecasts and massive unemployment? Why is the market doing so well? So the answer to that is the driver of the rally the past few weeks certainly has been, and including today, has been the talk of reopening the economy, which is creating a lot of investor optimism right here. And there's also additional reasons for investor optimism over the past few weeks, and they've been the massive fiscal and monetary stimulus provided by the Federal Reserve Board and the government. And there's also been some good news filtering in on several potential pharmaceutical breakthroughs that we may look forward to, maybe not so much in the third or fourth quarter, but maybe by early in 2021. And then there's been several foreign economies opening up, and they've been pretty successful. So that gives us encouragement that ours will be also. So the major metropolitan areas in our country, like Detroit, New Orleans, Houston, even Seattle and New York now, we're showing fewer infections. Mortality rates have been way, way down from original forecasts. And if you look at hospitalizations in former hotspots like Seattle and New York, they basically have now flatlined. So that's very, very encouraging. Now, we've had this big rally in the market, and my largest concern here is that we may be getting a touch ahead of ourselves, perhaps in terms of valuations. Even before the market came crashing down in February, stock valuations were at the highest level they had been in 45 years. We have snapped back to basically those levels now. So it may be the current stock valuations seem to be underestimating the threat of a deep decline in corporate earnings that lies ahead, the impact of high unemployment, and certainly a lot of the economic damage that we're likely to see in the next couple of quarters. We've never seen, however, this kind of liquidity injected into our economic system, which is likely why the stock market is going up, because historically stocks don't really rally or go up during periods of declining earnings. Our economy is going to recover, but it seems like the expectations may have gotten a little bit ahead of themselves in terms of the tangible data that we're seeing. The simplest way to look at this is that 70% of our economy is consumption-based. And right now, no one is spending. If people are not out there earning money, they cannot pay their rent or their mortgage. If landlords and homeowners are not making mortgage payments to the banks, then we have another fiscal problem. If small businesses are closed and not making money and they can't pay their loans, we have an additional financial crisis. And all of this actually explains the massive government interventions that we have seen in the past 3 or 4 weeks. In late March, every financial indicator looked as bad as it possibly could, almost like the world was coming to an end. That's in terms of credit, equity, volatility, fund flows, you name it, and it all looked pretty dire. Then came the Fed out with its $1 trillion injections to restore liquidity and stability and to allow those areas of the market, particularly the debt markets, to start to normalize. Now, the Federal Reserve Board is meeting this week, and it's expected they will reiterate their stance of continuing to backstop the economy. They will likely go over their current bond buying, which we interpret to be quantitative easing, and they may talk about how much further they plan to push their bond buying programs. Already we're starting to see that they're providing additional assistance to the municipalities, and initially they were focusing on larger communities. Now they're starting to come down to the ones that are more mid-sized and even smaller communities. So this has been basically ongoing. When you look at all of the programs they put in place, you almost run out of alphabets. There's the MSLP, TALF, CARE, PPP, FDMP, and so on. There's so many. In its 3 unscheduled meetings in March, the Fed has calmed the markets with its massive interventions. There's no doubt about that. It reduced the risks of market malfunctions and certainly restored, which we needed greatly, the liquidity to keep things on a stable course. It is possible that when the Federal Reserve threw everything in their power at the market with great speed, and I give the Fed Chair Powell kudos for staying in front of this. He's been very proactive through this entire process, and I think that really has allowed the markets to stabilize even quicker than it would otherwise. But by moving it with that kind of speed, they avoided a liquidity crisis in the markets that was developing and likely kept the markets from falling further than they did in late March. And by quickly buying hundreds of billions of dollars of securities, the Fed provided price support and may have prevented a wave of defaults in the corporate and municipal bond markets. The move kept solid businesses and municipalities afloat, who might otherwise have gone bankrupt through really no fault of their own. Now, we will be watching this week to see the Fed's economic outlook. I suspect they'll introduce that at the end of the meeting tomorrow in a press conference. We should get something about the state of the economy from Fed Chair Powell and an indication of perhaps other moves that the Fed may make to move the process along. Now, with that said, ultimately, whether the economy stabilizes depends more on slowing the spread of the virus than actions of the Federal Reserve Board. The big question is, how long will this virus last, and whether the current disruption to our economy will be sharp and short or sharp and longer. How long will we see or have to deal with social distancing, and how long will non-essential businesses remain closed? Well, we have sufficient evidence to say that certainly a recession began in late March in the US, when the effects of social distancing and government mandated lockdowns virtually crushed the economic growth in the country. So we think GDP contracted about 3.7%, at a rate of 3.7% in the first quarter, led by declines in consumer spending, commercial construction, and certainly capital investment. Whatever the rate turns out to be for the first quarter, it's going to be a bad number to look at. But everyone knows that. The contraction in the US economy, probably in the second quarter, is even going to be much worse than we've seen in the first quarter. And when you add that to the unemployment rate that is likely to be the highest level since the Great Depression, probably and possibly in the low to mid-teens, and I've seen some estimates where unemployment could be as high as 20%. So those are the things we continue to be dealing with right now, and I don't think many are really looking for a snapback in the economy right away. Although I did hear over the weekend, U.S. Treasury Secretary Steve Mnuchin say that he expects the economy to bounce back in July and August of this year, simply because of all the monetary and fiscal stimulus that is being thrown at the economy. But we think the most realistic scenario is that we will see a severe contraction in the economy in the second quarter, and less severe contraction in the third quarter, and perhaps stabilization and maybe even some growth some green shoots beginning to show up in the fourth quarter, but most certainly by the first quarter of 2021. The key, we feel, for our investors is to remember that none of this new information is not really new. Everyone in the market knows that the data coming out right now on the economy is going to be awful. We know that for the economy to get back on its feet, what we really need is to feel safe to go out and shop and eat at restaurants and to travel, is that we need treatments for the virus, and most importantly, we need a vaccine. So it's really unclear, even though we're opening up the economies right now, it's not clear yet how businesses and individuals are going to respond to this. Now, Dr. Deborah Baird, the White House Coronavirus Task Force Coordinator, she said yesterday that social distancing measures will be a fixture through the summer. Now, if that's the case, it's going to take a while for the unemployment levels to snap back. And it's going to be a challenge for the economy as we reopen here. We're going to continue with social distancing. And also we're going to see in the current new environment, I say new environment, that's post-virus, many people are going to have to really change their jobs. For example, we probably have too many waiters and waitresses and bartenders right now, and not enough ventilator technicians. So those are just basic thoughts about how employment will change. And this is going to take several months to sort through. So in order to see signs that we are pulling out of this recession, we're looking at several indicators that you can follow. First of all, the unemployment claims. This is a number that comes out every Thursday, comes out weekly. And it's been rising, as we know, dramatically. Currently, we have 26 million applying for unemployment in the past 5 weeks. Now, once that number of unemployment applications begins to peak out, that'll give us an idea that we're close to a bottom in the recession. We can also look at once the federal government's receipts for withholding of income and payroll taxes, those are reported almost daily. Once they begin to start to rise, we'll also have an indication that the economy is bottomed and we're about to begin a recovery phase and growth again. Now, we'll also look at high frequency numbers like auto sales, hotel occupancy, people traveling. This will give us an indication whether the economy is doing better. And certainly we have to also look at the stock market. The stock market, in my opinion, is probably your most accurate leading indicator for the economy that we have. And the snapback we've had in the market in the month of April is very encouraging for the economy. The economic outlook in the second half of the year again, is going to depend on how we unwind the social distancing. And I'm afraid to say that that's likely to be a slow process. Right now, as I understand it, there will be a very gradual reopening of the economy, which began in 4 states last week. And we're starting to see that expand to a number of other states this week. And that'll continue over the next couple of months. I know that here in Sarasota, where I am, they opened the beaches today, and there will be a few businesses opening up this week as well. But I've also heard that large crowds will not likely be able to gather until the first part of 2021. And that would fit with what we said earlier about the necessity of finding a treatment and a vaccine before we can feel very comfortable that we're safe. So that leads us to where the stock market might go from here. Now, generally, after a sharp pullback in the market, such as we had in February and March, stocks experience a big, sharp rebound. And that typically is followed by a bottoming or basing process that could take weeks or months. And sometimes you get a retest of the lows before the market really is set to take off on the upside again. And then once that occurs, once you go through that process, then there's a sustained up move in the market. And that's almost always led by small capitalized stocks. So that's something else we need to keep in mind. The current rally has been composed mainly of the 5 largest stocks in the broad stock market. Those are the so-called FANG stocks that we're all familiar with: Facebook, Amazon, Apple, Netflix, and Google. And there's a few healthcare companies that are also doing very well in this environment. But the S&P 500 index has become distorted because of this. Those 5 stocks represent 22% of the index. Now, if you go back and dig a little deeper into the middle of the S&P index, S&P 500, the average stock is off about 25% from its 52-week high, even though the index itself is only off now about 13 or 14%. So this has been a rally of large capitalized stocks, and will stay a rally of large capitalized stocks until we see a rotation into the cyclicals, small caps, financials, industrials, and materials, that which will show that the economy is getting back on its feet and we are indeed pulling out of the recession. So we need to see that rotation. Just as a note, however, yesterday and even today, from early indications of the stock index futures that I looked at early this morning, yesterday was a good day for 4 cyclical stocks in the Dow. As an example, Disney, which has been hard hit, had a big rally yesterday. 3M, an industrial stock depending almost exclusively on the strength of the economy, had a nice move on the upside yesterday. JP Morgan, a financial company so dependent on the strength of the economy, had a big move, and Dow Chemical also had a nice move. And I might add that the Russell Small Cap Index was up over 4% yesterday. That's really a good beginning. So if we're expecting the economy to pull out of the recession, these are the type of companies you would like to see rising in price in this environment. Interestingly enough, yesterday, the 4 worst performers were Procter & Gamble, Walmart, Johnson & Johnson, Microsoft, and Verizon. All of those had been safe havens during the turmoil. So we may be seeing this rotation that we're looking for to give us comfort that everything is about to return to a more meaningful or stable condition in the markets, and probably opening up the markets for growth. So it was just one day yesterday, and maybe today is another, but 1 or 2 days is basically meaningless until we start to see a real solid trend develop. But certainly this is a nice beginning, and we're very happy to see that. Now, where do we need to go if we're going to invest in the market today? I think we continue to urge our clients not to sell on big, high volatility down days, and not to get excited about these big surges on the upside either. I think in this current environment, there's so many unknowns yet out there in terms of the economy, corporate earnings, and how fast this is all going to heal, that the best policy right now is to be patient, to buy high quality stocks and bonds on market pullbacks, and to continue to upgrade portfolios. Traditionally, defensive sectors such as utilities and real estate have been areas of the market where investors have typically gravitated to during periods of volatility. But I would say in the current environment, the new defensive sectors are the technology sector. And that's thanks to social distancing companies that are busy improving their IT structures to accommodate employees while working from home. The healthcare sector has been a good performer, and we can continue to believe that will be the case going forward. There's going to be a bigger and bigger emphasis on treatments and testing for the virus. And as we see, a lot of government money is flowing into healthcare and trying to help hospitals out. Consumer staples have done very well in this environment, and that's because we continue to consume a large number of amounts of household products. But most importantly, the consumer staples area is an area where there are very dependable and higher than average dividends. So a lot of folks have gravitated to that, and we continue to suggest that's a good place to be also. Communication services, that's the home entertainment software, but it's more than that. It's remote work, and that requires a lot of processing centers opening up and expanding, and that area has done extremely well. I was asked last night, what did I think would happen to the economy and the markets if the virus returns in the fall? Well, the scientists on the White House Virus Task Force have said that if the virus returns in the fall, that we will by that time have some reliable drugs to treat the virus, and that the virus will not be as severe as it is now. If we don't have a severe outbreak in the fall, I believe investor confidence and consumer confidence will begin to ratchet up significantly. But it looks like the world is going to emerge from all of this a little different than what we are used to. What I think we can look forward to is household savings rate are likely to go up and maybe go up a lot. A lot of households found themselves ill-prepared for a shutdown on the economy and the loss of jobs. I think we're going to see a lot of low-cost manufacturing likely to come back to our country from overseas, particularly from China. That's going to add a lot of stability and dependability to our economy. And my feeling is that over time, that will allow price earnings ratios to perhaps expand. Financial leverage, I believe, will be less in fashion. And by that, I mean, you're going to see fewer stock buybacks. Companies are going to treat cash not as trash. They're going to be husbanding cash as much as possible. And once again, when your balance sheets are loaded with cash, it puts you in a pretty strong position going forward. So we may see more of that. We are currently engaged now in the most rapid industrial mobilization in the country that perhaps we've ever seen since World War II. Companies are mobilizing to repurpose their factories from making things like T-shirts to making hospital gowns and masks. Ford and GM are making ventilators. The economy and the American way of life, I feel, will be much better after all of this is said and done, and certainly more secure. Now, I've been speaking daily for the past 6 weeks with different groups of people within Baird and with our clients and financial advisors. And I can tell you that for all the heartache and suffering, the optimism is strong, very strong among our people. And I suspect that's the case throughout the country. I see people are helping people everywhere I look. They seem instinctively prepared to fight this virus. I am bullish on the markets, but I think it may be choppy waters this year, and we may bounce back and forth as investors react to the news, both positive and negative on both the economy and the virus. But in closing, I would say I am bullish on the scientists and business and government leaders who are directing us out of this crisis. And I'm also bullish on the American citizen that he and she is following the guidelines set out by the government until we see our way clear of this very, very unusual situation. Thank you.
Thank you so much, Bruce. That was a very interesting and engaging presentation. And as I joked with you before we got started, I think I'm going to set some time aside to rebalance my portfolio after hearing all of your words of wisdom here. We have gotten a few comments in the chat box, and I've gotten a few texts as well. So I'll just ask you a few questions and see if you can share some additional insight. Can you talk a little bit about your forecast for the airline industry and the oil industry? I mean, these are two areas that have been very hard hit. A lot of uncertainty in the future. What does the stock market look like considering those two sectors of our economy?
Well, it appears to me that those two sectors, which have been the hardest hit, if you will, they're going to take some time to snap back. In terms of the airline industry, I think you don't have to go much further back than the 9/11 episode. And after that tragedy, it took the airlines about 3 years to recover from that. And I wouldn't be surprised if it takes a couple of years for it to recover from what we're going through right now. Until there is a vaccine and a reliable treatment, there's still going to be a lot of folks that will be unwilling to travel and to be in close contact with other folks. So I think that's going to be problematic going forward. In terms of the oil industry, they're going through a tremendous disruption now. Even yesterday, the price of oil, even though the markets were up and people were upbeat about the economy, the near-term contract for oil dropped down again to near $10 a barrel. Now, these oil companies in our country need at least $40 oil to break even. So we're going to see a lot more shutdowns, a lot more defaults, and it's going to be slow going for the energy complex until the economy certainly stabilizes and begins to grow again. And this big disparity between the supply and demand for oil gets normalized. So both of those areas are going to take a while to stabilize and to grow again.
Very interesting insight. Thank you. What about manufacturing? You talked about what manufacturers are doing to pivot. What about original equipment manufacturers and suppliers? What is the general forecast for auto manufacturing as well? Can you touch on that a bit?
Well, auto manufacturers have been hit hard. Also, the demand has just fallen off a cliff like it has for a lot of consumer areas. But eventually they'll snap back. But I think the larger question is, what are the supply chains going to look like going forward? And I believe over time, it's not going to happen immediately, but over time that's going to change. And a lot of that manufacturing is going to come back into the U.S. Now, it takes about 30,000 different parts to put a car together. So if you just miss one of those parts, you have a problem. So it's going to be a slow process, but I believe eventually a lot of that manufacturing is going to come back to the U.S. And like I said earlier, that's going to lend a lot of stability and dependability. We're not going to have to be so dependent on places like China. And you'll probably see that first develop in the pharmaceutical area, where we have learned recently by shock to some of us that almost 90% of our pharmaceuticals come from China. Now that has to change. So there's going to be a lot of changes going forward. The economy is not going to look the same as it did in 2019, but I think longer term, it's very bullish for us going forward, and certainly for our children and grandchildren.
And you mentioned several emerging markets or markets that you're seeing become stronger, like tech and some healthcare companies doing well and consumer staples. Are there any emerging markets that might not be on our radar right now that you see moving forward in a very strong way after this, the post-COVID economy?
Yes, well, emerging markets have been hit by a couple of things. One, of course, a slowdown in commodity prices, but they're primarily commodity producers and benefit from higher commodity prices, and commodity prices have been going south, not north. So, but they also are highly indebted areas, and they're indebted basically in dollar-denominated currency. So the dollar has been particularly strong here. What we need to see for emerging markets to benefit from all of this would be for the dollar to weaken, which it might over the course of the next year or two, and that would certainly help emerging markets. But I think initially you want to stay in the U.S. I think the U.S. holds much more opportunity, particularly in times of stress, than almost any other part of the world.
And we also know that the stock market, the economy in general, has a major impact on elections. And elections have a major impact on the stock market. Can you talk a little bit about how you view the impact of the election as it relates to this crisis?
Well, if you go back 100 years or more in our country, the markets have done equally well, whether it's a Democrat in the White House or a Republican. If you put it on paper, you'll see it's almost no difference at all. Of course, the media makes a lot of this and raises the visibility of all of this, but I think common sense tells us that really when you go back and look at the performance of these markets over the long haul, it really doesn't make that much difference. With all of that said, I would say the history books show that the markets would like to see, they're much more comfortable when the incumbent wins the election. And the reason for that is they know what they're dealing with. They know what the policies are. And so the markets are much more comfortable when the incumbent wins an election. So that's the only observation I would make in terms of the politics.
Sure. When you think about the hit that the stock market took in 2008 and 2009, what are some of the similarities that you see, and what are some tips for things that we can do to have a stronger recovery? I mean, is it all about confidence? What are your thoughts on that?
Well, the difference between 8 and 9 and the present situation, in 2008 and 9, we had a bubble in the housing market, and that triggered a lot of stress on the financials and the financial community. And of course, you had Lehman Brothers and Bear Stearns go out of business. You had big names like Merrill Lynch that were a foundation for our financial community, if you will, have to be taken over by the banks. So it's a totally different situation than we experience today. In the current environment, what we're having here is a total shutdown of the economy. That's never happened before. Well, we've gone from a vibrant economy to a totally shut down economy overnight. And we're dealing with a pandemic as opposed to a financial crisis. So they're two different animals. I would say the difference today in 2008, however, has been the response by the Fed and the government. Like I said earlier, Fed Chair Jerome Powell deserves a lot of credit for being ahead of the curve here and not waiting for the numbers to come out and show such desperation. He's been out in front of all of that. And so has the government as well with their programs to support workers. So, and the reason for that is so there's jobs to come back to when the virus situation dissipates. So the situation, I think, is quite different, although in both cases we experience what we call waterfall declines, but in the present example, it looks like we're snapping back a lot quicker than we did in 2008 and 9 perhaps, but that's to be seen.
We know that Kentucky has a major logistics base. We're just curious, do you think that that's going to be a permanent shift, that they benefit from this e-commerce and distance shopping concept? Do you think that the logistics sector will come out ahead on this?
I don't know, it seems to me like places like Louisville and Nashville were the heart of the country, and a lot of commerce filters through those two areas. Certainly there's going to be changes. You're going to probably see a lot of changes in the commercial real estate market, for instance. As become more comfortable in working from home, we may be less inclined to go out back to the mall and go back to our comfortable offices. So there's going to be some changes and shifts in the economy in those respects. But I would suspect that places like Kentucky and Tennessee that are right in the heart of the nation are going to continue to do pretty well.
And what about bankruptcies? Have you heard a number, or do you have a speculation on how many businesses will end up going bankrupt during this crisis?
No, there's no way to know how many. There certainly is going to be probably a healthy amount. But with that said, the Federal Reserve Board and the government has supported these businesses and supported the debt markets and supported areas of the economy that would have basically already defaulted had it not been for that backstopping. So we're likely to see a far less number of bankruptcies than we would have seen otherwise.
And what about the foreign markets? Some Asian and European countries are ahead of the US in reopening, and the crisis hit them first. Are there indicators that we should watch for in these foreign markets? Are there certain foreign economies we should look to as we reopen?
Well, that really is a good question, because they seem to be opening up in some areas sooner than we are, and they might be a good guidepost. But what I'm looking at is interest rates overseas. And right now, the yield on the benchmark 10-year German bond, for instance, is about negative 40 basis points. If I would start to see that gravitate back into positive territory, it would suggest to me that the European area of the global economy is improving significantly. And if that's the case, that's a pretty big block of economic activity. And if that's the case, that could spread and support our economy as well. Although with that said, the US economy is really the anchor of everything. If we suffer a recession, it's very, very likely that the global economy will suffer even a worse recession. So a lot of it depends on how well we do here.
You know, when this all began, I kept hearing that this probably wouldn't be a recession, it would be more like a depression. But I keep hearing you use the word recession. Is that your belief, that it will be a recession and that we probably won't spiral into a depression? Or can you speak to that for a minute?
Yes, you know, when the stock market started to really tank in late February and the first few weeks of March, there was a lot of commentary that this looked like 1929. And I pushed back against that immediately because it was totally different than 1929. In 1929, you had so many policy mistakes by the Federal Reserve Board and the government that really caused that to be much worse than it should have. Whereas in the present example, the Fed and the government had been so proactive here that it was between night and day. I didn't think there was any chance we would slip into a depression. I thought a recession might linger longer, perhaps because of the nature of our problem being the virus, and that might linger. But no, we were never concerned about us slipping into a depression or anything like that.
Well, that's very encouraging. You know, we are hearing a lot about what this virus is doing to impact our health. We're learning a lot about that, and we know that this virus is testing our economic capabilities as well. So your expertise today has been invaluable. I know I've pummeled you with questions. I think that while this is rare, we were able to get to all of the questions in the chat box. So thank you for being so concise and being so knowledgeable about the stock market and the volatility and our economy going forward. And thanks to all of you for joining today. We are in this together. As the voice of the business community, we're going to continue to bring you valuable resources through this COVID-19 help resource. We have recorded this webinar today and it will be posted on our Crisis Hub. So feel free to check back on that hub. You'll also be receiving a survey later today. Please weigh in and tell us what you thought about the webinar. We hope you'll join us for our next webinar, Small Business Cybersecurity in a Crisis. That will be, I'm sorry, that date is wrong. Check back on our Crisis Hub for the upcoming webinar on cybersecurity. So thank you all again for joining us. Please be safe and be well.
Thank you.